Well, it's top of the hour. Time to get started on this month's webinar. I'd like to welcome everybody to the webinar here today. It is a well-attended webinar, which I was a little surprised for October 15th when I saw that date. A little concerned, but obviously you are all the people prepared for tax season. Sorry, I was just looking at who is on here right now. So let's get going. Today we're going to be talking about year-end tax planning, even though we're just getting past year-end. And one thing I want to just check with our group, I actually don't see that attendees are coming in yet. Just verify that we do have the attendees in here right now.
They usually come in flood through, don't worry.
Okay, just making sure. It's going to be recorded, so if anybody's late, they'll hear the recording. So we are doing, like I said, we're going to talk about year-end tax planning for 2025. I know today you're just wrapping up 2024 filings, and congratulations to you. I do see the attended list populating now, so that's great. Congratulations to you to getting to this day. And obviously, if you're attending this, I assume you got past this day, October 15th, and wrapped up all your 24 filings, although there's a few other additional returns that may come out later in the year. But congrats on getting through the year and being prepared and being on top of things and not letting everything wait till the last second. And that's what we want to do today, is we want to get you prepared for your client base for 2025 tax filings that obviously occur early in 26. And we're going to talk specifically about how HR1, some people call it OB3 or OBBB or OBBA. I'm going to probably say HR1 all day today because that is the official name. But we're going to talk about strategies that you can use going into 25 based on what happened in this most recent tax bill. So that's what we're going to go over today. Let's get into a little housekeeping. So this is available for CPE. You know the rules. I assume all of you have gotten CPE before, but just to verify, you need to stay logged in for at least 50 minutes. We will keep this open for more than 50 minutes. So you should, if you're here now, you should be able to get your 50 minutes in. You need to answer 3 of the 4 polling questions that will pop up randomly during the presentation. We'll try to announce it, but you need to be alert and watch those pop up as well. Very easy answers. I think you pretty much just have to say if you're here or not. And either answer is correct, even if you say you're not here. You will get credit for answering that CPE poll. Unless they changed them on me today. I guess we'll find out. I'll be surprised. The certificate will be sent out to the email address that you registered with. Just verifying you check your spam, because it has been known to go in there at times, or your junk email, just to make sure you receive it. But that should go out fairly fast. I didn't clarify ahead of time, but I'm guessing by early next week, you should have your certificates and a copy of the slide deck if you haven't received that already. All right, that's housekeeping. Let's get into introductions. I'm actually, well, they put me first. I'll go first. I'm Randy Crabtree, co-founder of Trimerit Specialty Tax Professionals. I'm very fortunate. I get to do a lot of cool things in this profession that I love, and there's just a list of them there. It keeps me excited. It keeps me going. But one of the most exciting things, the most fun I have, is doing these webinars for all of you, because you are awesome people doing awesome things for your clients. Phil, I'll hand it over to you.
So while Randy's doing all the really cool and fun things, the rest of us are getting the work done. So I'm on that side of the things. Phil Williams, been with Trimerit for 14 years, or coming up on 14 years. Been a partner with the firm since 2018. Held various roles between operations lead, audit lead, project management. It's something that we all have a passion for, is helping our clients with these different credits and incentives. So hoping to bring a lot of education to you today.
Thank you, Phil. And as Phil just said, that's one of our passions, is bringing education to you. That's one of our missions, is to be able to educate the profession. We want to actually make the specialty tax world, or the accounting world, the tax world, better by providing specialty tax services to you the right way. You know, we do this through our technical expertise, our knowledge, and integrity with what we do, and education, the marketplace. So it's just a little bit about who we are. R&D cost seg, renewable energy credits, some other incentives around properties that we'll talk about a little bit today. But that's everything we do. We support you and give you the ability to bring these tax saving opportunities to your clients. And as part of that mission, we try to give back in areas where we can. We do a survey in the profession, and it's a satisfaction survey. I'll leave this up for a second, but if you want to take the survey, the 25 surveys out right now, you can scan that QR code and take that survey. We get a lot of really good data that we've been able to use to help firms around the country lean into areas that they can help create satisfaction levels within the profession, within their firm, retain and attract employees, and where they're short on things, we can identify those areas as well. So I just wanted to let you know that this is one thing that one of our missions is just to be able to give back to the profession. And one last plug before we move on. Many of you have heard of our conference, Bridging the Gap. Bridging the Gap just happened in July. That QR code is going to bring you to the landing page for 26 Bridging the Gap conference. The registration is not available. The date and location is not available. We will have that out shortly. But be alert right now if you're interested in seeing anything about what's going on with Bridging the Gap. We are going to have a road show. Well, at 99.9% certain, we're going to have a roadshow that's going to start as early as next month, half-day events around the country. So watch out for that as well, but scan that QR code at least to get yourself in the email list for next year's conference. All right, that being said, let's move on. The agenda today. What's our learning objectives? What are we going to talk about? Well, we're going to talk about things that are important to you and to your clients. Your clients, I'm a CPA, I was a generalist for years. I know how clients look at you. And one, they look at you as a hero because you help them with tax saving opportunities. You being on this call today are looking at tax more than compliance. You're looking at tax as an advisory opportunity, which it should be. And because of that, we're going to help you with these advisory opportunities that you're going to be able to bring to your clients in a few different areas. We may touch on it a little more, but mainly the R&D tax credit obviously was affected in HR1, a pretty positive impact that happened there. But then we're going to talk about some form filing issues that we need to be aware of. Cost segregation, what happened in that in HR1, or depreciation in general. 178ID and 45L, these are two different energy incentives around properties. One's commercial property, the other is residential rental property, any depreciable property, but we're going to talk about those. That's one you need to really concentrate on and be aware of because there's some significant deadlines that just got defined in HR1 that this is the perfect opportunity for you to talk to your clients about. And then renewable energy tax credits. You know, as HR1 was going through, it was before it was called HR1, I think, we were hearing all these things with renewable energy, what's going to happen, what's not going to happen, what's going to change, is everything going to get killed, is there, you know, all of these things were in the air. There was some changes, not nearly as major as we expected, and a few positive, a few negative, but overall, renewable energy tax credits exist and pretty much exist for the most part as were going forward, at least from a tax planning standpoint. But there are some deadlines on that we need to be aware of. So that's what we're going to be talking about today. And again, when you're dealing with your clients, you know, I know, we all know, they want you, not that you should be, they want you thinking about them 24/7. So if we can equip you with enough information that you can think, okay, hey, based on what Randy and Phil talked about today, I should call, you know, ABC company because I think this incentive is something that they should be aware of. And now that that deadline is looming, this is a great opportunity to have a touch point with their client. And so to show that advisory, to show that you're thinking about them, to show that you're in their corner for tax savings, that's what we want to do today, is try to equip you with that. First thing we'll go into is R&D. I actually always start with R&D. I should probably mix these up sometimes, but R&D is what Tri-Merit started as. R&D is where I have a lot of passion, although I have a lot of passion for all of these. So we're going to stick with R&D for now. And there we go. So what are the opportunities? So what I'm going to do is I'm going to define what happened in HR1, where areas that we need to be concerned about, where areas that we need to start thinking about with our clients. And then we'll go dig a little deeper into there. And then I'll just do a quick refresher on R&D, just so you know what we're talking about. But I figure let's start with what happened in HR1. So in HR1, biggest thing is the 174 capitalization rules. We all know this. We know what happened. We'll talk about the mechanics of that. But with this, the first thing we should be thinking about when we're in tax planning season, which starts, it probably started before this, but technically we're going to say it starts today because we finished tax filing season today. So in tax planning, first thing we need to do, if we haven't done it already, and some of you probably sent letters out already to your clients, hey, this has happened, this is what happened with 174, this is the capitalization, but we need to start having a touch point with all these clients. We need to look at our manufacturers. We need to look at our software developers. We need to look at pharmaceuticals, engineering firms, potentially, architect firms, potentially. Phil, any additional list you want to add to a type of clients that they should be looking at, thinking about as we talk about capitalization rules?
Well, as we go through and talk about not only the capitalization rules, but also the new form requirements, I would think anybody that is doing product development, anybody that's doing process development, software development, and they're going through an experimentation process. You've got those two things. It could be a clothing manufacturer. It could be a lot of different industries. So keep those in mind.
Keep those in mind. And then because we've been under these capitalization rules, and again, just as a refresher, starting the year 2022, we had to start capitalizing R&D expenditures. Never had to as far back as 1954, but in 2022, we started to have to capitalize this. And so many of our clients have been capitalizing then since that point in time. And so simple things that we need to do from an advisory standpoint is, hey, let's talk to them. What are they currently doing on their financial statements? Are they still handling those as capitalized cost, which obviously we can do financial statements different than tax returns. And just so you know, first poll is up, so make sure you answer first poll. But let's start with more of a CAS point, accounting service advisory, and let's look at financial statements to see where they are. Maybe they do want to continue to capitalize on financial statements, but then let's make sure we know that we need to make an adjustment come tax time. Does this capitalization make sense for them, the situation they're in, or is immediate expense and make sense going forward? Just conversations that we need to start having. And then let's talk about the ability to expense R&D expenses immediately, because the message may be out there that people think, okay, this is it. I can start writing all these off. Well, it's not completely it. Domestic, which actually is now defined under 174A, domestic R&D expenditures can be expensed immediately, but foreign expenditures still need to be capitalized and amortized over 15 years. So that hasn't changed. So then the question comes in is, should I convert some of these offshore expenses I've had? Maybe, it's very common for software development to be outsourced to maybe India, Philippines, somewhere else. And those costs, if we continue to do that, are not going to be a current year tax benefit, at least not completely. 1/15 approximately of those will be written off each year. And so from a tax planning standpoint, was I outsourcing just because I don't have the staff available? Was I outsourcing because the cost was cheaper to outsource to a different country? We need to analyze that from a tax advisory standpoint and say, is the benefit of today's deduction with domestic expenditures more important or bigger, or I'm going to increase my cash flow, even though maybe the expense is larger, by reshoring, let's say, those expenditures, bringing that back to US based. And that's a big part of what this bill is trying to do too, is put incentives out there to spend money within the US. And the last few bills have done something like that. So the discussion then is, what should I do with these outsourced costs? Should I continue them? Should I bring them into the US? Should I bring them in-house? Should it not be outsourced anymore? Those are the types of things, discussions you could have. But even if it is domestic, then does it make sense to amortize still? Am I in an NOL right now? Is it, tech startups? It's not uncommon for them to spend a lot of money on R&D they're creating losses and they're looking for future growth or selling the business in the future. And so does it make sense for us to capitalize and amortize those? Maybe it helps with financial statement. The EBITDA looks on that as well. And so that decision has to be made. Does it make sense for me to have this immediate tax savings, or do I even need it? And then what's the impact if I don't need it? What if I am in an NOL? This is something you have to look at. Am I increasing my NOL? There's limitations that I'm using those NOLs. Can't say NOL apparently going forward. And so those are the discussions that need to be had. And some of this, but I just want to highlight the fact that these are the things you have to think about in addition. And then when we're looking at this, and on the next slide, we're going to go a little deeper onto these changes. But on this next slide is, hey, you know what? What are my options for maybe recapturing cost that were capitalized in 22, 23, 24? How are my 280C elections affected by this HR1? Did I take prior credits? And are those prior credits going to be affected if I go back and amend past returns? And we'll go deeper into this in a second. But did I even take credits? I mean, let's see, how do I put this? There are some clients that I know didn't take credits. I'm not saying they were eligible or not, but if we reanalyze in 22, 23, 24, where people didn't take credits, does it make sense to look at credits for those years now, even if they weren't taken for whatever reason? And so that's an area that we need to look at as well. I don't know, Phil, anything you wanted to add on that?
No, I think that's pretty spot on, Randy.
Of course it is. All right. Hey, we got to have fun on these. All right. All right, so now let's talk about specifically what HR1 did, and then the guidance that we've received on how we handle the capitalized cost that were on our tax returns for 22, 23, 24. And there's really two different buckets of clients that we want to look at for this. The first bucket is what's considered, at least for this definition, a small business. And a small business in HR1 is considered a business that has average annual gross receipts at the control group level. Just be aware of that. So we have to do that analysis. Again, when you're doing tax advisory, we have to analyze this at the control group level, and we have to do that with the R&D tax credit calculation as well, just as a side note. And so if their average gross receipts, if they fall in this bucket, if they fall in this first group of businesses and they're considered the small business for this, we have a couple different options. We can amend 22, 23, 24. And actually at this point, I think 24 could be considered a superseded tax return. I think there was some guidance that said we have 6 months either from the date of filing. Do you know this, Bill?
No, it was still, you still had the traditional
amended
filing deadlines.
Okay.
All right. Read funny. I can see where you're coming from, but it
did read funny because it also said a deadline by, something in 06 to actually go back and do the amendments, but that is not accurate. Okay. So what we need to do is we have to make the decision. Do I go back and amend? If I go back and amend, what that does is allows me to write off those capitalized costs in the year they were incurred then. So let's say 22, or 23 or 24, any of those individual years, we were in a taxable situation. If we go back and amend, now we've got additional expenditures in that year. We're going to get a refund, carry it forward, get a refund, whatever we want to do with that. But if that's the situation we fall in, then the decision is, did they take a credit for that year or not take a credit? Do we want to take a credit still for that year or not? That's just a decision point you have to look at. You have the ability to do that still. But one of the major things that's going to affect that amended return is your 280C election. Did you take a reduced credit or did you take a full credit? Now, you had the ability, based on the Tax Cut and Jobs Act, the way it was written, to, in most situations, take the full credit without affecting expenses. That was the way that the Tax Cut and Jobs Act was written, whether it was written incorrectly or not. That's the rules that we were guided by, that we felt, and actually IRS put some comments on it, so they realized it was written that way. And so now in HR1, it says, okay, if you go back and amend, you have to basically now either take a reduced credit or you have to add back the expenses. So that's pretty much reversing the rules we were under from the Tax Cut and Jobs Act. So now you've got to look and make that decision. Do we do this? Do we not do this? Those are things we need to follow up on. The other option for us is we can choose not to go back. We can choose to just write off the remainder of the capitalized cost in 25 alone, or spread that out over 25 and 26. And in 25, we would start writing off the expenses as incurred and continue to do that going forward. So again, two options: go back and amend, potentially affect the credit, potentially affect 280C, or just go forward, write off the remaining capitalized cost over 1 or 2 years and write off the current cost in the current year incurred. Now, some guidance came out recently, which was nice, which originally indicated that we needed a Form 3115. At least that was the assumption. That's no longer the case. You basically just have to put a note with it that says, hey, this is what we're doing. So it saves you a lot of time and effort on filing 3115. Just checking with you, Phil. Fact check me. Are we all good?
I'm going to chime in with one other thing, and it's a mention that I'm going to say, and nobody can rely upon this. Obviously, we're talking through, some of the discussion within the industry, and we're actually waiting for the IRS to come out with some type of a notice addressing this. But one planning opportunity may be if a client took an R&D credit in 2022 through 2024 and did not make a 280C election, which most of the clients that we worked with did not, then they, from what we're hearing, and this was from somebody that actually participated in the writing of the notice, what we're hearing is that you can take that accelerated amortization in 2025 or spread between 2025 and 2026 and not make any 280C adjustments. So, that could be a significant difference depending upon the size of the credit. Whereas if you did go back and wanted to change to expensing in those years, you would have to make the 280C adjustment. So again, you can't cite this. This is not a private letter ruling. This is not a notice. But I would anticipate some more IRS thought via RevProc or via notice to come out on that here in the next, hopefully, month or so.
I would agree with that, and that's actually the way I was reading it was that same way. Hey, we only make this adjustment if we go back. Again, don't rely on this, but that's the way I was reading that as well. So that makes sense. A great point there. Thank you. All right, let's move on to the next bucket of clients. And the next bucket of clients is obviously anybody that didn't qualify into that first bucket as the small business, is these taxpayers with average gross receipts over $31 million. They are still under the capitalization rules in 23, 22, 23, 24. Obviously, we're past 24 filings at this point. They don't have the ability to go back and amend. But what they do have the ability to do is what we said, the second option for the small businesses is write it off the remainder of the capitalized cost in 25 or spread that out over 25, 26. They do have that option of either or, correct, Phil?
That is correct.
Okay. And so from a tax planning standpoint, again, if we write this off all in 25, is that putting us into losses? Are those losses going to create NOLs? Are those NOLs going to be restricted on usage? Just things that you need to look at going forward with tax planning, or do we spread that out over 2 years and not affect NOLs? But there's a lot of opportunities, but the bottom line is just be aware we have multiple options on the small businesses. We have really one option that could be spread out 2 different ways on a large, no amending going backwards. Again, if they didn't claim a credit in those past years, there's always that opportunity to do it. I'm not saying that they should. I'm just saying that that's always open if they needed to go back and amend 4 credits as well. Again, same thing. Oh, poll number 2, just be aware, poll number 2 is up and we're going to keep going. Again, no 3115 required. That's pretty much what happened on HR 1. Those are the rules that are actually creating a lot more opportunities for R&D expenditures occurring in the US. And we've seen that uptick. We've been in contact with a lot of clients that have decided to invest in R&D again. And so it is at least creating the benefit that it looks like it was intended to create by having investment in U.S. R&D. The next change, not specifically related to HR1, but a change you need to be aware of, because this change, especially with less taxpayers investing in R&D over the last few years, they may not have noticed this. There was no requirement yet, but the form itself is changing. The form 6765 is changing. As you see up top, I did this form was actually originally going to kick in 24. Nope, cross that out. It was going to kick in 25. Nope, we just heard 2 weeks ago they kick it down to the road to 26. So this is something you need to be aware of. The way that the documentation is going to be moving forward, you need to be aware of. And this is another opportunity for you to talk to your clients to make sure that they've got records in place to support their credit. And so what is this change? This change is a new section in Form 6765. This new section, and I'm going to go back forward for a second, then I'll come back to this screen. This new section, and we just broke it out here, you need to identify a lot more information on Form 6765 than we've had to in the past. This actually originally came into play on amended returns a handful of years ago, where IRS came out with a notice saying, hey, if you're amending a return, we want you to give us a lot more information to support your R&D tax credit claim. That was pretty much a precursor of what has happened now. And what has happened now is we have to basically list the business component that the credit's based on, the type of business component that is, the activities that were happening on it, the expenses associated with those business component. Bottom line, to be aware of, this needs to be added to the filing. It is now based on, it's called a nexus or specificity. We need to tie expenses, tie QREs, qualified research expenses, directly to the qualified activity or the qualified business component. And that's the major change. And that's not just a form change, that's an IRS looking at audit change. This is the way they're going to be looking at things to substantiate your credit going forward. And I'll ask Phil to expand on this in a second. But before I do, the IRS went back and forth with us, with taxpayers, asking for input on what do you think of this form, what should we do. And one of the positives that came out of this was, okay, this is going to be a burden on small taxpayers whose credit might not be $2 million a year, and this extra record keeping is going to put a burden on them. Now I'm going to say this: they still need to keep these records, but at least they don't have to report it on the tax return itself. So there was kind of a de minimis rule that kicked in for Section G of Form 6765. And this basically says, if I qualify as a qualified small business under Code Section 41, blank, whatever the section is, and the qualified small business is this business that can make the election to use the R&D tax credit to offset a portion of their payroll taxes. So if I meet that requirement, which quickly means that for the most part, I haven't had any gross receipts further back than the last 5 tax years, and my current gross receipts are less than $5 million. If I qualify under that scenario, I can make an election to carry my R&D tax credit to my 941s and offset not everything, but a portion of your payroll taxes. If I meet that requirement, I am exempt from filling out Section G. And then there's an or if my gross receipts are less than $50 million and my total QREs are less than $1.5 million, it's another way to be exempt from filing Section G. Now, this is not required. It wasn't required on 24. It's not, as of October 1st, not going to be required on 25. It is under the IRS's notice as mandatory in 26, other than these 2 exemptions. Feels like we'll wait and see on that, because this is already got pushed down the road so often. But this is the other change you need to be aware of, and you need to be talking to your clients about, because they need to make sure that the documentation is in place to be able to fill out this form. Phil, anything additional on this?
Yeah, I will chime in with one of the things. There's been a lot of focus put on that Section G, and obviously this discussion's been going on since September 14th of, I believe, 2022. So this is not a new talk. So a lot of focus on Section G, and a lot of folks that are saying, hey, we're under that $1.5 million QRE threshold, or we're under 50 million in gross receipts. We don't need to be worried about that. But the gotcha that nobody's talking about is in Section F, there is still a line item that says, how many business components is this claim based off of? And I've seen a lot of these that have come through that don't have an answer given, which, to me is a red flag. To me, that's a potential audit issue. It's also a potential audit issue if you just swag it and say, we've got about 10. Well, then, hey, we go to audit and they say, all right, well, explain to us how those 10 business components come in. So you can't be super dismissive if you're still in that smaller category. It's a little bit easier. Obviously, it takes some of the burden off, but still pay attention to it. And Randy, what's the word? Specificity.
Specificity.
Yes.
That's a word I have a hard time remembering. So Phil just told me use Nexus. All right, perfect. All right, thanks, Phil. We'll move on from that form. We've got a lot on R&D, so I'm going to spend 2 minutes on this. Just remember, for R&D tax credits, we said at the beginning, the most common clients that you're going to talk to are anybody developing software or any manufacturers. Those are it. And to qualify, they meet this 4-part test, which means they have a new or improved product, process, technique, formula, invention, or software, which is what Code Section 41 says. There's technology involved with what they're doing, engineering, computer science, biology, chemistry, some kind of hard science involved. There's uncertainty in the project. We don't know if the outcome is going to be what we expect from day one. We have to try different iterations. We have to evaluate different alternatives. And because that uncertainty exists, we're going to experiment. And that process of experimentation is the timeline that we quantify the R&D tax credit on. And we don't do it based on the employees. We do it based on the business component, the projects. And then we tie the employees and the other expenses to that. That's your quick refresher of what the R&D tax credit is. All right. Whew. That was a mouthful, but R&D has a lot. Depreciation and cost seg, not as much impact, but there's some significant impact that happened in HR1. So let's talk about that, because again, this is another opportunity. We're at year end now. We have to see what was going on with clients. Do they have a property that they're currently under construction? Do we want to try to put that as a placed in service date before the end of the year? Or does it make sense from a planning standpoint that we don't need that additional deduction this year? Let's push it into next year. There's a lot of things that we need to look at there. But here's what happened in HR1. So bonus depreciation, you've all heard this, you've all cheered. We heard when this passed, we heard a rounding roar across the country that we're able to have 100% bonus depreciation. You all heard that, right? You heard that, Phil, right?
I heard that.
All right. And so that was a big deal. This is very taxpayer friendly from that standpoint. Interesting date, but probably not interesting. It was any assets placed in service after January 19th of 2025. I think we all know what happened on January 20th of 2025, day of inauguration. So we were tying it to that date. And so what we need to do is just analyze our current year expenditures. Obviously that's always part of your year-end planning. But your clients are not always the best at letting you know what happened during the year. And so just making sure that that's a highlight, because 100% bonus will be a significant benefit when we're trying to reduce taxes this year.
Chime in with one more thing there, Andy. So
yep.
And a lot of this is we're getting more information on this and trying to present on almost in real time. So some of the transition rules around bonus depreciation, again, this is just to clarify, the building needs to be both purchased and placed in service after that date. So what's been a little bit of a gotcha on some of these big projects is they may have started construction in 2022, and now they're just coming around and being placed in service now. If that's the case, then the TCJA bonus rules still apply, and for 2025 will be 40% bonus. Except if you did have contracts that were entered into after January 19th as part of that project, then there is support for bringing those elements in with 100% bonus. So you can still do it. Again, the complexity is a little bit, the level goes from here to here, but you can do it with part of it. So just want to
no, that's good, because that's I actually hadn't heard that, so I appreciate that. And so then another big thing though in depreciation, and this is kind of a variation of bonus, and this is a pretty cool one, and this is a new bonus eligibility, call it bonus, for manufacturing facilities. So it's the qualified production property. A qualified production property is, and we'll define that in a second, it's eligible for 100% bonus. Now, we're going to say there's only specific parts of the building that are eligible for bonus. This is the facilities itself. And so what do we need to do? I mean, this affects directly to manufacturing. So the first thing you need to be doing is going through your client list and who are my manufacturers. And now let's talk to them about this and see what's going on. So what is this? Let's dig deeper into it. It's Code Section 168N. It's the manufacturing qualified production property. Obviously, the incentive is to, have manufacturing in the U.S. What would typically would be deducted over 39 years now is, for the most part, bonus eligible, a portion of that building. Now, here's the current rules. We'll see if this changed at all since I wrote this, but to be eligible, the facility must be placed in service before January 1st, 2031. So there's a deadline. And construction needs to start again that January 19th, between January 19th or after January 19th and before January 1st of 29. There is actually a caveat out there for existing property, and I think I might have a little of that on the next slide. But before we do that, what is considered a property? More so, I'll tell you what isn't considered a property in a minute. But it's basically a manufacturing facility, something that's used for production, refining of tangible personal property. Just double check anything you want to add there, Phil.
No, I was just going to say, having grown up working in manufacturing, specifically related to automotive, I think that there needs to be thought put into this if there is a facility being developed, because some of the specific areas that don't qualify for 100% bonus related to QPP are areas like shipping and receiving, warehousing, the R&D department, the front office. And I think back to a couple of the plants that I used to work at, and the biggest area was shipping and receiving and warehousing. That's where you're just keeping finished product. So this is going to be a cost segregation-esque analysis. And obviously, we want to get whatever we can for our clients, but I just don't want to see anybody go into it with the assumption of, hey, we're going to spend $25 million on this building, and 100% of it is going to be qualified under QPP. It's some of those gotchas.
Yep. No, good point for sure. So as I mentioned, 100% bonus, blah, 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 but again, not on the entire property. So, it's again, do we need it? Do we want to make this election? Do we not want to make this election? Those are discussions you have to have. I have a lot of properties with the depreciation level they're at already are going to show a zero. Typically these are going to be in a different LLC or something. They're going to be show zero taxable income. Do we need to increase it? Do we tie that with our manufacturing facility, which we can do in certain situations, and then use that loss there? That's a possibility. But as I mentioned, there is a special rule. I'm not going to go deep into this unless Phil wants to do something. But for properties that were existing and purchased, there is a chance that you can qualify for this if you meet certain caveats. Do you have any additional information on that, Phil?
No, just that it's a great opportunity. Find that vacant building or find a building that was used for something else. It's not going to likely rise to the level of constructing one yourself, but you can still take advantage of this. So huge opportunity there.
Yep. And then what I said, so this is it says, at least a portion of what it says that the property can't be used for. And Phil mentioned this, office administrative spaces, lodging, parking facilities, areas dedicated to sales, spaces for research, as Phil just said. And next polling question is up. So I just want to make sure you all see next polling. That's 3 of the 4. You get this one and stay on for 50 minutes. You qualify. Congrats. Research, software, engineering functions. I highlighted the preparation of food because we talked about, manufacturing. You could look at food as manufacturing, but this is saying if you're prepping food and it's in the same building as a retail establishment, that is not considered a manufacturing facility. Basically, we're talking restaurants for the most part here.
I just manufactured myself a sandwich for lunch. Is that what you're trying to say?
Exactly. So just be aware of that, because you may get that question. Obviously, if clients hear about this, hey, we're taking property and turning it into something else. And then, the highlight, the bottom line is not directly related to manufacturing, production, or refining of tangible personal property. So these are the things that you can carve out, or not can, but have to carve out. And so that's just what Phil said earlier. When we're looking at this, we're really looking at a cost segregation opportunity, because we have to go in there and we have to identify what meets the QPP requirements for 100% bonus. But when we do that, the opportunity again is tremendous. So this was a big change, along with the 100% bonus in other places. This was a big change that allowed potential significant write-offs on these newer properties. And I haven't been looking at Q&A. I forgot. I don't know if you've looked, Phil, or not, but we'll take a look as we go here. And as I said, like we did with R&D, just a quick reminder. I just mentioned cost seg. What is cost seg? Cost segregation, the full word, is basically looking at a depreciable property and breaking that property down into components to see what components we can depreciate at a quicker life. Often it's 5, 7, 15 years. Anything 20 years or less is often going to be considered bonus eligible. But except for the QPP, even though it's a 39-year property, we're going to reclassify that as a property that can be written off in 1 year. And so that's what cost segregation is. And so that's going to be important, obviously, with QPP, and just in general, if you have any investments in enhancements to new construction, improvements, additions to properties, cost segregation is usually a decent benefit for those taxpayers. All right, let's move on to the next two. We're going to lump two together here and talk about them, because these are very well related cousins, I would guess you'd say, 179D and 45L. And so what happened to these two programs? Well, these two programs have accelerated termination dates. This is significant ones. This is ones that you have to be very aware of when you're talking to clients, because 179D, and we'll define that a little further in a second. Hey, Phil, are you typing a lot? Can you mute while you're doing that? Sorry.
Sorry about that. I was answering the Q&A.
Oh, good call. Thank you for answering that. So 179D is now has a new deadline, and the new deadline for 179D, which was a permanent part of the tax code before HR1. So projects, we say breaking ground, but there's some specific rules on this. They have to be under construction before June 30th of 2026, or by June 30th, 2026, to still qualify. If they're not under production by that date, we're out of luck. And so we just need to look at, hey, do we have taxpayers? Do we have clients? And let me expand on this a little bit later when I define 179D, but I'll tell you the clients that we need to talk about with this. And so this is a deadline. This is a looming deadline. This is a hard deadline, and we need to be aware of this. So we need to identify the clients. In fact, let me tell you the clients you need to identify right now. Anybody that potentially owns a commercial building. For the most part, lessees can qualify, but we normally look at owning a commercial building, or any designers of either a government-owned building or a nonprofit-owned building. So when I'm talking designers, I'm talking architects, engineers, different areas that potentially doing design work on those two. So those are the thought process, but we'll define that in a little bit further in a second. And then the second one is 45L. 45L was for developers of residential property. They have to be placed in service, which means sold or basically leased to take this benefit. And this is a hard deadline. If these properties are not sold or leased by June 30th of 2026, they no longer qualify. No matter if they're under construction and they're sitting waiting to be leased or sold, at that point, we lose the ability to take this credit. So again, we need to look at, it's important to accelerate maybe placed in service date. Do we have obviously we need to figure out if they qualify first. You don't want to be pushing place to service dates if we don't know the property qualify. But this is an area you need to talk to your clients who maybe are developing residential property and say, hey, you know, what properties do you currently have under construction, and what's the opportunity for us to get as many of these as possible placed in service by June 30th, 2026. Any further on that? Either of those, Phil?
No, keep going.
Okay. So a quick definition then, just so you know what we're talking about. The 178 ID is the energy efficient commercial building deduction. This is, there's certain requirements that we have to meet. I'm not going to go into those, but the clients, again, that benefit from this are the commercial building owners, or again, architects, engineers, somebody that's designing the government-owned building, or a nonprofit owned building. Because what happens is, if an architect, let's use architect as an example, they're designing these properties, that nonprofit or that government property can't use this deduction. And so what they're allowed to do is allocate the deduction to the designer. So this is a significant savings for these designers. You know, they already have, you know, it's not like a depreciable property that may create a higher NOL for them. They're usually running out of profit. And when we can allocate this deduction to them, that's a pretty significant tax savings. So this is something we have to see if we can get under construction by June 30th of 2026 so that we can still get this deduction allocated to them.
On those, it's 5% of construction completed by that date, and document the heck out of it.
Yeah, perfect. Documentation. We didn't, you know, we talked about documentation with the R&D, but obviously everything we're talking about, documentation is going to be important. And then a quick recap on what 45L is. 45L is the energy efficient, the credit for developers of residential property, as I said. Again, it could be up to $5,000 per unit credit. I think that might be inflation adjusted for this period. I don't know. 5,000 is always the number I've gone with, so we're going to stick with that for now. The 179 ID has been inflation adjusted. I know that. And so just developers you need to talk to. As I said earlier, do we have anything under construction? Can we meet this deadline so that we can take this credit? Because if we can get 5,000, and not every client's going to get 5,000, there's a scale where you may get less. I mean, it could be 500, could be 2,500, could be 5,000, depending on certain requirements it meets. I think it could be as low as 250 as well too. But if you meet any of those requirements to do it, it's something that you have to look at. You don't have enough time to dig deep into that, but that's another client base to look at. And we are running out of time, but we're going to go to one last thing. In renewable energy. This is the one I said at the beginning that we were hearing a lot of buzz about when this bill was being debated in the Senate and the House. And so what happened to renewable energy? I'm going to highlight some key things here in renewable energy to keep you aware of. Renewable energy, been around a while, major impact in the Inflation Reduction Act. The Inflation Reduction Act defined sections for 45, which is a production tax credit. I guess I'm getting ahead of myself. And 48, which is investment tax credit. A lot of those rules ran through the year 24. Those rules are still safe on those properties that were qualifying under the original Inflation Reduction Act. 25 already had changes defined that were automatically kicking in. Some of those are still good. Some of those have newer deadlines. So let's talk about 45 quick. And this is just going to give you an idea of things you need to be aware of. Solar and wind had the most impact in HR 1. And so solar and wind right now, if you have a facility that's producing power through solar or wind and basically selling that to someone else, for these facilities to qualify, they have to begin construction after if they don't begin construction by July 4th, if they do this after that date, they have to be placed in service by December 31st, 2027 to still be able to take advantage of this production tax credit. So far, so good, Phil?
So far, so good. I'll add one thing, because it's a little bit different than what we just said about the 5% of physical construction complete test for 179D. There's different rules for this, and there's different rules because they were written very vague, which concerns me. I like to have like if we're going to follow the rules, let's like actually say what the rules are, as opposed to just putting words on paper. But with this, they talk about you have to have substantial construction complete, and then they go into things like if you're putting up a wind farm, you need to have the anchor bolts for the windmills that have been installed. So it's another example of document what was done, because obviously there is legislative momentum against these incentives, and could that be weaponized later on? Perhaps. So on the safe side, document the heck out of it. That's all I got.
Yep. And then the other thing you need to be aware of is that we need to really analyze these projects to see if they are affected by some of these rules, which is the prohibited for an entity rules, or the FIAC, and what's the other one? Did I put both the same here? Phil?
What's the FIAC and prohibited for entities?
Yeah. Okay. So we need to verify if we're being affected by any of these two. We're running out of time here. Fourth poll is up, so get your fourth poll in right now, and let's move on to a little bit on investment tax credits. Again, solar facilities were affected. You see the dates they need to be placed in service or construction started by to be able to get this investment tax credit. This is taxpayers that are investing in facilities, in this case solar, that are being used on their facility. They're using solar to help run their facility, whatever their facility is. And then again, the FIAC rules, the prohibited foreign entity rules affect them, and you can see the dates there. 45X, I wanted to be able to touch on this because 45X is a pretty cool incentive. 45X is actually available for manufacturers. We talked about with the R&D tax credit, we potentially have additional benefits for them. So when we're talking about manufacturers, a lot of the stuff overall can affect manufacturers. I mean, we're talking cost seg, we're talking about the QPP, we're talking about R&D tax credits, and now we're talking about 45X. So really a major client base that you need to look at for a lot of these things are manufacturing based. There is additional, obviously, but this is something. The renewable energy can be used from all different types of entities, including nonprofits too. And so you can see some deadlines. One of the things that was added, and I don't have that listed here, but I listed that no credit after December 31st, 2029 for metallurgical coal. That actually was new, metallurgical coal, and that's the first time I've ever been able to say that word correctly, was added in HR 1. Again, you have to look at these FIAC rules and these prohibited entity rules to make sure that your taxpayers, your clients aren't affected by them. But with that all being said, for the most part, and I'm not going to go into these slides, but for the most part, if you have taxpayers that are investing in renewable energy, they're putting up, they're using geothermal. They're still using solar, which still has a lifespan, not as long as it used to be. They're still using wind, still has a lifespan, not as long as it used to be. They're using any type of potential renewable energy, which is not product specific anymore. Before 25, it was. Starting at 25, we basically just have to show that we have a net zero greenhouse emission effect, no matter what type of technology we're using. And if we have that, there's a potential for a renewable energy tax credit. So that being said, any client that are doing anything that looks like renewable energy, we need to talk to them. And if it's specifically wind or solar, we have to tell them that there's a deadline that got accelerated. So if you're in the process of doing something to your facility already using either of those two powers, we need to really look at that and make sure that you have started and you have that under construction and you meet the requirements for placed in service date. That's probably the biggest planning opportunity you need to be aware of with renewable energy. Before I close it out, any renewable energy thoughts, Phil?
Keep going.
All right. Well, I think that's where we're going to end it. I have more slides in here for you. I'm not going to go into this because this is more what is renewable energy, but I thought this is probably where we have the least knowledge base out there, I'm guessing, in the profession. And so you're going to get a copy of all these slides. And I wanted to put those in your hands in case there's any questions. You can always reach out to us. One of the slides that I really like to highlight is this one here, the program timeline. This shows you things that have maybe changed, things that are consistent to where they were before. But if you have any clients that falls in any of these specific areas, you can look at this cheat sheet and get an idea of what the dates are that I need to be aware of so that we still can use these opportunities in planning and meet the required deadlines. It's a starting point. Digging further to make sure there's been no more guidance come out, make sure that there's something that hasn't changed. We're always available to answer questions on that, but that's the key there with renewable energy, is just make sure we hit any deadlines that loom, because all of these have a deadline at some level. One thing, anything you see in red in these slides too, these are changes that came out of HR1. You can see where it's funny, in the manufacturing, solar wasn't affected for 45X, even though it was affected from the ITC and the PTC standpoint, but the 45X it wasn't. But wind was. Even though wind was affected in the ITC and PTC, it was, it is affected in the 45X as well, where solar wasn't. And then you can see the metallurgical coal was added as a critical material. You can see there's an increase in the ITC available and for certain taxpayers from 25% to 35%. And then we just talk about some of the more ways that you can take advantage of this. All right. I think we're at 56 minutes. I actually have to catch a Uber to the airport here in 5 minutes. So I appreciate everybody being on here today. I always enjoy being with you, and good luck in tax planning season, and let you know that we're always available, whether we're working with you on a client or not, to answer any questions that you may have with this that we discussed today, or anything else that may affect your client from a tax and credit and incentive standpoint.